Hey everyone, we're back with a new video, and today we're talking about how to create a pro forma balance sheet for your own situation. My name is Brandon. I'm the CEO of Poindexter, which is a product that has helped thousands of businesses create their own pro forma balance sheets without the need for spreadsheets. So we do have some experience in this space, but today we're creating this video for entrepreneurs and students and other people that don't have the background in finance or accounting to create their own pro forma financial statements without the need for outside help from financial professionals. So our goal is to help focus in on the balance sheet, and by the end of the video, you'll be able to walk away and create your own balance sheet without the need for outside professional help. The reason why we're creating this video is because the balance sheet itself is pretty difficult to deal with. It often makes small children cry and has been known to give grown adults mental breakdowns. Obviously, that's a bit of an exaggeration, but it seems that even on YouTube and other search engines like Google, that there's this avoidance of the balance sheet in dealing with it, in teaching how to go about creating one. And I think that's really because of the fact that the balance sheet isn't as simple as some of the other financial documents. And so in order to fully comprehend it, you need more of a comprehensive background in finance or accounting to understand how it's put together. But today we're going to get rid of those concerns. But generally, the balance sheet itself, the technical reasons is for its difficulty is because of the fact that it's taking information from the income statement and the cash flow statement. So it needs both of those documents in order to create a full balance sheet. So it's not the same as an income statement where you can just focus on that almost in isolation and still understand what's going on and how to create one without explaining those other two documents. In order to discuss what a pro forma balance sheet is and how to create one, it'll be helpful to cover first what a normal balance sheet is. And ultimately, it's a list of all the stuff a business owns. And that can include cars, warehouses full of inventory, storefronts or buildings, if you will, that holds your storefront. And it could include also the debts attached to purchasing any of those things. And a pro forma balance sheet, in contrast to the normal balance sheet, is a future version of the balance sheet. So it's the desired state or the future state of the balance sheet, or the goals of what the business should own in the future or what you would like to own in the future. And the cool thing about the balance sheet is that in order to figure out exactly what goes on it, all we need to do is understand a simple equation. And that equation is assets equal liabilities plus equity. Now, you may be sitting here thinking, Brandon, you just told me a balance sheet is a list of things the business owns. And liabilities are not something the business owns. They own the business, or they own you, right? And yes, that would be correct. But based on this equation, we can kind of think of liabilities as something the business owns. They own the obligation to pay that liability back. And I say that simply because of the fact that liabilities and equity are simply just smaller components of assets. They're equivalent to assets. So assets are things that the business owns, right? And we can see that by switching around the equation to assets minus equity equals liabilities. And then vice versa, we can switch that around to assets minus liabilities equal equity. So ultimately, everything is equivalent to assets. Everything on the balance sheet is an asset or equivalent to assets, which is why I say that. There are finer distinctions we can make for sure. And as a way to illustrate what those finer distinctions are, I think an example would be helpful. So we'll purchase a dump truck, for instance, which is a thing that the business can own, a physical thing. And that dump truck has to be financed via some mechanism. And that can either be through a liability that we have to pay back over time, like debt, or through equity on the balance sheet. So we might have cash in our bank account that is a result of retained earnings, which is an equity piece of the balance sheet. And not to get too far into the technicals right now, but this example kind of helps illustrate some of the distinctions that can be made between what an asset is and its financing mechanism, either liabilities or equity, which is essentially how we distinguish between what assets are and liabilities and equity are. It's not always going to work this way. There are some assets that are not tangible, that are not actual things that you can hold in your hand. But I think for the purposes of a general conceptual worldview of what a balance sheet is, I think that is a good place to start. Let's take a look at an actual balance sheet just so we can solidify some of the things that we're learning so far. And we'll keep our assets and liabilities plus equity equation over on the left-hand side. And we can see that by honing in or chunking down some of the balance sheet, that that equation represents more than just an equation. It's how the balance sheet itself is structured. So we have our assets up top and our liabilities and equity on the bottom there. And lo and behold, if we hone in on what the totals are for each section, look at that, they're both equivalent. So that's where the balance sheet ultimately gets its name from, that the total assets have to equal total liabilities and equity. So if we're wrong in one section, we would know because they wouldn't be equivalent. So it helps kind of check our work as we go by having both sections be equivalent. It's a pretty nifty little trick, accounting trick. We don't need to understand the exact intricacies of what's happening behind the scenes here, but just know that that's what the balance sheet is supposed to do. It's total assets is supposed to equal total liabilities and equity. We can even separate the sections of the balance sheet down further to notice even more similarities. So if we take a look under assets, we have current assets, and then if we take a look under liabilities and equity, we have current liabilities. And these two sections are almost mirrors of each other, so they're two sides of the same coin. And what they represent is activity that happens on the balance sheet as a result of normal business operations. So normal business operations presumably will happen every day, and so these two sections of the balance sheet could theoretically at least be updated every single day. So there's a lot of activity happening. And if we take a closer look at what is included in these sections, we might notice under current assets, so cash is included. So cash might be something that the business would be using every day in normal business, and that goes the same for inventory. We might be selling a physical product, and that might be something we're constantly selling and buying. And on the liability side, we might be purchasing our inventory from a vendor a lot, weekly, for instance. And maybe it happens so often that that vendor has extended us a line of credit that we only need to pay off once a month, and that would be representative of our accounts payable. Next, we can take a look at long-term assets and long-term liabilities. And just like current assets and current liabilities, they represent similar things. They represent areas that the business has made longer-term decisions. So the business might decide to purchase equipment that would last for hopefully multiple years. Likewise, on the liability side, the business might take out a loan to finance that equipment, and that loan has a maturity over multiple years. So not as much activity happening in these sections. They represent, again, bigger decisions, conscious decisions that the business makes. So there's not as much activity ultimately going on. And if you're a newer business, you probably won't have too much to deal with as far as creating a pro forma is concerned. But we will go over a couple examples just so you know how to deal with it. Lastly, we have the shareholder's equity section. And whether you're a new or existing business, there's not going to be too much to deal with here as far as creating the pro forma is concerned, because it's pretty simple. It represents the area of the business that capital has been raised either from founders or from investors, and also contains our retained earnings, which is the lifetime earnings of the business. But ultimately, it'll take no time at all to go through that section. We'll spend a majority of the time really focusing on the current assets and current liabilities side of things, because those are the parts of the business, the balance sheet rather, that are constantly updating through the course of business and require, whether you're a new or existing business, you're going to have to build as part of your pro forma. Now that we have some background knowledge, we can start to jump into actually creating our pro forma. You'll notice that we already have 2 years of historical performance here filled in. And if you're doing this for a new business, don't worry. It'll actually still be even easier for you because we're starting off with a blank slate. It'll actually be more difficult in a lot of scenarios to do this for an existing business, just because we have to back into some things, which we'll get into in a little bit. But we'll start off with current assets and then just kind of move down the line all the way until we get to shareholders' equity, and we can finish everything off. But as I mentioned earlier, with the fact that there's different pieces of the balance sheet that reside on either the cash flow statement or the income statement, we're not actually going to start with cash, because we get the cash forecast rather from the cash flow statement itself. So we can't actually start here. So we won't actually get a balance sheet that balances until the very end. So with that being said, we'll start off with accounts receivable. And with most of the balance sheet, so we're gonna have to attack this line by line, which actually makes this again, more difficult than dealing with like the income statement, for instance, and forecasting that, because they require their own individual forecasts. So I'm actually going to go scroll down here below, and for the purpose of forecasting accounts receivable, and actually we can think of it for most of the things in current assets, since these are things that are highly used in the normal business operations, we are going to use the income statement to forecast most of these things. And the reason is because the income statement represents the performance of normal business operations. And so you'll notice that accounts receivable, we might use some percentage of sales or revenue rather. And inventory, we might want to use some other percentage of some line on the balance or on the income statement rather. So we can kind of think of these things as proxies of different elements of the income statement they represent. So we're going to use the income statement in forecasting each line item. So for accounts receivable here, I've created a little section for it and how to forecast it. And I've chosen revenue as a sort of the method for forecasting accounts receivable. And the reason for that is because revenue tends to be a pretty simple just fallback option for representing business operations because it is the size of your operations throughout some periods. So we're just going to bring revenue here from our income statement. Oh, and I forgot to mention, I did include a pre-built income statement and cash flow statement in this download, which you can download in the link below. You can either download the blank document that you're looking at now, or there's also a fully completed version that I'll include as well. But I did this just for sake of ease and focusing solely on the balance sheet for this example. But if we go over to income statement, we can capture our revenue. So we'll capture revenue for total sales for year one here of our forecast. Oh, I did that wrong actually. I got the wrong year. Income statement, and then we'll go capture actual year one here. I probably could have labeled that better, but that's what I get for doing this live. Anyways, so now that we have our income or sales rather from the income statement, we can actually ask ourselves, okay, what are we going to do with revenue? How are we going to forecast our accounts receivable from revenue? Well, we can grab our existing accounts receivable right here, so the tiers that we have, and then all we need to do really is just divide our accounts receivable by revenue to determine what percentage of sales are typically on credit. So we notice that, and this is a good rule of thumb here, is that you might want to try out a couple different line items. So revenue might not be total revenue might not be the thing you use. You might want to use, maybe people that are eating inside this restaurant are more often using credit cards than people that are using the patio because, maybe they're on a beach and there's flip-flops involved and board shorts and they only carry cash. I don't know. But the way we can tell is that the percentage here should remain fairly consistent. That's how we know there's a good correlation between what we're forecasting here, which for this purpose is accounts receivable, and the thing we're using to forecast it, which right now is revenue. But for accounts receivable, revenue tends to be a pretty good proxy, so we'll just use that going forward here. And I'm just going to use the average of those 2 years, and then I'm going to use that going forward. And then now all we need to do is take our revenue that we've forecasted already on the income statement, multiply it by our percentage, and we get our accounts receivable. So very straightforward. And a lot of the things in the current liabilities and current asset section, you can forecast the same way. You're going to be using a lot of percentages from the income statement. And we're going to see another example here in a second on a different way to go about this. So we'll just fill in our accounts receivable here. So I'm just going to take our forecast, drag it along. All right. And we now have our accounts receivable, which is pretty cool. Next, we'll move on to inventory, since it's the next line item. And we notice that for inventory, we're going to use cost of goods sold. We're not going to use sales because, and you'll know hopefully which ones to choose, which line items might be most appropriate if you are familiar with the business you're going to be doing this for. But inventory is a cost, or shows up on the income statement in cost of goods sold for the materials that might be used. And actually, it might be even better, instead of using cost of revenue or cost of goods sold, to use the actual meals that have been sold, because that's where the materials or the inventory comes from, or that's how it's being sold or accounted for as a cost on the income statement. So we're going to use cost of goods sold, though, because that is just easier to deal with. We're not going to have to deal with multiplying or adding multiple line items. Go ahead and capture cost of revenue or cost of goods sold. Kind of can be thought of in a similar fashion, as long as we're not taking an accounting final. And so now we have our cost of goods sold brought over here from the income statement. We have our inventory here, so we know what that is for the past 2 years. Inventory here. Drag that over. And then, again, we're just going to take inventory, divide it by cost of goods sold, and hopefully we get a fairly consistent percentage. It's not too bad. Okay, so 15, and we would probably get a closer percentage if we had just used those two sub line items in cost of goods sold that I just mentioned, but for this demonstrative purpose, I think this is fair. This is good enough. So we're just going to use the average of both of those, and you don't necessarily need to use the average, but it just helps. I did not spell that right. It just helps kind of smooth things out. Let me do that. Okay. And then again, all we need to do is take our forecasted sales from the income statement, or cost of goods sold from the income statement, and copy that down. Okay. So you'll notice that, again, not only are we using percentages here, but for new businesses, this might be a little more difficult, right? Because we don't have those historical percentages. Well, you might be able to just look up what percentages you would expect as far as receivables would be for your industry, or if you have more in-depth knowledge of people that are already operating your business, what you would expect as far as what receivables would be, or what inventory would be as a percentage of your cost of goods sold, for instance. So you can just start out with some assumption for these percentages, and then if you find out some more detailed data and information, especially as you start to actually engage in business, you can input your own percentages there and get a better forecast. But you'll have to start out with some assumptions up front at least, and get more detailed as you go. So go ahead and copy that, or translate that up here to our inventory, drag it along, and then now we have most of our current assets done. And we're just going to sum this up to get our total current assets. And we will get to cash at the end of this once everything is complete, so that hopefully we'll know whether everything balances. Next, we have our kitchen equipment, which is both easy and hard, I guess, depending upon what you need to do. So if you don't plan on purchasing any new assets, it's quite simple. All we need to do is just drag the existing value forward into the future, because the value of our assets for kitchen equipment stays the same. However, if we're going to purchase new equipment, such as dishes and silverware, because possibly dishes keep breaking or getting lost and silverware is thrown away or stolen by the customers, hopefully not. But what you can do in this situation is purchase some more, and we'll go through what that entails here down below right now. So we have our dishes and silverware section set up, and let's say in year 4 we want to purchase an additional $25,000 in dishes. And the only other thing we need for dishes is the depreciation, because we're not allowed to deduct the full amount of dishes that we purchase in this year 4 off of the income statement immediately, which would mean that if we are doing that, we're deducting from our taxable income here, which is right now represented as EBITDA. But right now you can see that depreciation is taken out from taxable income to reduce taxes. And so the reason depreciation exists is because we can't take it all in one year. We're supposed to take it, if we buy $150,000 of equipment, we have to take that depreciation over multiple years to spread out the taxable gain, or not taxable gain, but taxable benefit rather, that we get from purchasing. So right now we're going to make up some random depreciation for these dishes. Let's say they on average last for 5 years, and so we can depreciate those the cost of the dishes here linearly over 5 years. So we're just going to divide it by 5. There we go. We get $5,000. So, and then for the next 2 years, it's going to be $5,000 individually that we get to take off of our taxable income. And then if we took this out further, the taxes would end over in this area here, which would be year 8. But we only have year 5, so that's how much we're going to include. So now we just need to make sure we include the existing depreciation for the assets we already have on the balance sheet. And so if we're going to limit this conversation just to the assets that we actually have on our balance sheet and try to limit the influence or at least the need to look at other financial statements, because we can find this information on other financial statements if you know where to look. We can still figure this out without looking anywhere else. Just because of the way that this example is set up, we can see that we don't have any difference in the asset values between 2 years ago and last year for both of these assets. So there was nothing new purchased. So that means that the difference between accumulated depreciation for this year and last year, right, 2 years ago and last year, are going to be the linear depreciation that was deducted. And if we test this out here, we can come down here to our little schedule. We can take the depreciation from this past year, subtract accumulated depreciation from 2 years ago, and we end up at 3365. And we're just going to turn this positive here. So we're going to wrap this in an absolute bracket. And then, so that should be our depreciation that was already existing for the year. And the way we can double check this is depreciation does exist on the income statement, if you are familiar with that. So we can actually come over here, check our depreciation, and see that 650 rather, is the depreciation. And so we can see that it was actually lower the year before. So some assets were purchased in this prior year 2 years ago. But since nothing was purchased in this entire year, and we can see that by the fact that the ending balance of 2 years ago and the ending balance of last year is the same, that nothing was purchased in that time period, that we can deduct both of these accumulated depreciation to find the amount that it results in. So hopefully that provides a little deeper insight into how we can think about these numbers and come to arrive at different conclusions and figure out problems based on the way that things work here. So I'm going to sum these up to get our total depreciation. And we can see that we have up until year 3, the same depreciation. And then when we purchase more in year 4, there is now the added $5,000 depreciation amount. So we're going to take this amount and we are going to add it. So we're going to take our existing depreciation, because it is cumulative, and add on our new depreciation. We're going to drag that forward, and we're going to add on our dishes and silverware purchase as well. So again, this is cumulative because it adds on we're going to have these existing assets still. We're not going to throw them away or anything. And then we're just simply going to add our new purchases. And then we're just going to drag that. And there we go. We go from 35,000 to 60,000 rather in dishes. And we just need to sum this up to get our total for fixed assets. And we should be good to go. Now we can add our total assets together by summing the fixed assets and current assets. Cool. And so now we can see that our balance check is starting to show some red errors, and our next task is going to be to get rid of those. So we'll look to accounts payable for our first step. And this is going to be very similar to what we did for accounts receivable. We're going to use some line item on the income statement as a method, or as the method for forecasting accounts payable. So we'll go ahead and look at expenses in this scenario. So let's take expenses from the income statement. Operating expenses are here. Drag that across. And then now we do have 2 years on the balance sheet previously for accounts payable. Okay. Drag that across, and we're just going to take the percentage of expenses. And hopefully this is a semi-consistent percentage. It looks like it's a little bit maybe not as close as you'd like from jumping from 1.6 to 2.17. So there might be a better barometer for that we can use at least for forecasting accounts payable. But you know, this is a rough example, but hopefully in your business you'll know the levers that actually change your accounts payable and receivables and things of that nature a little better than I do for this random example. But we'll go ahead and continue on with using the average here for accounts payable. And then we'll just take the expenses, multiply them by our percentage, and we now get our accounts payable. And we'll just make sure to translate that up into our balance sheet. Drag that over, sum that up, which I don't really think is necessary since we only have one line item, but that's what it is. Okay, so again, you know, for the percentages that we're arriving at here, even if you don't have existing percentages because you're a new business, you should be able to find a way to, whether through Googling or through talking to people in your industry, get some reasonable assumptions for these initial percentages, and these are just going to be your assumptions that you're going to go with for your beginning balance sheet until you can start generating some real data. So the last thing we have to look at in the liability section is our loan, and this is the biggest one that we're going to have to overcome. I was debating whether we're going to go into this example or not, but I decided that we should do it because if you can deconstruct this line item, you pretty much have the foundation of most of the things you're going to encounter on your balance sheet, at least for a basic balance sheet. So I've written down some of the components that come with a typical loan. So usually there's a beginning balance, there's an ending balance, and interest, and a payment of some kind, right? So if you have a credit card, this is very similar. And we can actually do the same thing for credit cards within the business itself. But the idea here is that we're just going to use the balance sheet as much as possible to find out what all of those components are. And right now we're only left with this ending balance. So we have 2 years ago an ending balance of $245,000. This year, or last year rather, is $188,000. We don't know when this loan was taken out. We don't know how much it was taken out originally for. This is what we're going to have to deconstruct, but we're not going to get to what the original balance is because we don't really care. What we care about is what we're forecasting going forward. So what we do is we look at year one, and we know that, well, we don't have any of this information for year one. All we have is the ending balance, right? So let's just fill that in here. 245,833. Okay, so that's pretty much it. There's nothing else we can do there. So for year two, we can hopefully start to fill in some of these holes. So year two, the beginning balance, well, we know that because it's the ending balance for the prior period, right? Okay, and then we also have the ending balance because that's what's on the balance sheet. So now we kind of have the bread of our loan sandwich here. So let's see if we can start to fill in some of the lettuce and meat and so forth. That's the last time I'm going to refer to the loan as a sandwich, don't worry. But the principal paid, well, if we think about the principal, what is that? That's really just the reduction in the loan balance, right? So we should just be able to subtract the original loan balance for the month or year rather, and then subtract the ending balance and arrive at what was paid off. So that's the $56,938. So now we have a piece of what consists of our payment here. So now we have interest as the last remaining component of figuring out what takes place on a month-to-month or year-to-year basis within our loan and the lifetime of our loan. The interest rate itself, we're going to have to look to a different financial statement. This is one area that there is no getting around it. So what we can do is look to our income statement because interest is tax deductible, just like it is with our mortgages and student loans. We can take the interest off of how much we pay in taxes, so the business is no different. So we can see that we had interest here, expense of $10,999 for the second year. So we can go to interest paid and we'll just input that. Select interest. Okay. And now we can actually get our payment because the payment is just simply the interest plus our principal. So we can actually continue that forward because the payment's going to be the same every year or every month. And then now we can get the interest rate by dividing the interest rate paid by the beginning balance. This isn't going to be an exact interest rate, but rather. But it should be close. It should be close enough, at least for the purposes of forecasting cash flow and doing what we need to do. This is going to be nearly good enough. So I wouldn't worry too much about that. So now we can select the ending balance to use as our beginning balance for every year here. And now we can take our, whoops, I did this wrong. There we go. And then now we can take our interest rate times our beginning balance. Excellent. And now we can take the amount we paid and subtract the interest to get our principal. And now we can take the principal and subtract it from our beginning balance to arrive at our ending balance. And now we just gotta drag these forward. And there we go. We get our loan balance at the end of year 5, which is almost paid off by then. So hopefully that provides some insight into how to deconstruct some of the sort of hidden information, or kind of if you think about how the balance sheet works and you know it well enough, you can start to get to some numbers that don't necessarily seem super apparent when you're left with only an ending balance, for instance. So we'll go ahead and continue our balance sheet balance here for the next 3 years. We will sum up our long-term equity, or long-term liabilities rather. And now we can sum up our total liabilities by summing long-term and current liabilities. Drag that over. Okay. All right. And now all we have left is shareholder equity, which should be the easiest section for us to get through now that we've learned what we've learned so far. So arriving at the first line item, paid in capital, we don't have any paid in capital on the balance sheet yet, and we're not going to expect any paid in capital to be received going into the future. So we're just going to include a $0 balance for the entire forecast. But for common stock, we do have some issued already, and we're going to just assume the expectation that we are going to raise a little bit more money in common stock in the future here. So in year 3, let's go with year 4, we'll do $25,000. And just so you know, the paid in capital would work exactly the way we're doing this right now. And all we need to do is take the existing balance that continues on into the future, because it doesn't go away. We add any new issuance down here in our common stock new issuance section. We can now drag that forward, and there we go. We get our new balance for common stock in year 3 there of our forecast, or year 2 of our forecast rather. And preferred stock, we're just going to continue that with a $0 balance going forward as well. And then we come to our last line item here, which is retained earnings. And retained earnings is the lifetime earnings of the business. So it's the total cumulative net income of the business over its life. And so since it's cumulative, we always need to grab the old balance, and then we're just going to add what we're including for net income in the new year. And there we go. So now that way, when we drag it across and we dive into the last number here, it's always including our previous balance, and then we're just adding the new year's net income on top of it, so we can keep track of the total amount of net income over the life of the business. So now we can start to sum up our, if I can type, the shareholder equity. All right, and then now we can sum up the total liabilities and equity of the business. So let's grab total shareholder equity and total liabilities. All right, so we're almost done here. We can see that we're chipping away at the balance check here that we have left. And if all went well, it should just be the difference in cash that we had left from the top here. So since I only wanted to focus on the balance sheet for this demonstration, we're going to go to the cash flow statement, and it should already be calculated for us. But generally, you'd have to calculate all of these things, and then you would arrive at what your final cash balance was for the period at the end of the cash flow statement. And so we're just going to grab that number there. Press enter. And then we're going to copy that and paste it so that we can grab it from all of the years. And we can see that our balance check went away. So that is generally it. I know that skipped over a few steps because of the fact that we needed some of the other financial statements. We did already do a video on the income statement, the pro forma income statement. So if you'd like to watch that, I'll include it as one of the tiles you can click after this video. But if you'd like to see a video on the cash flow statement, please let me know. Please leave a comment and I'd be happy to do so. Otherwise, I hope you liked the demonstration that we went through today. If you did, please like and subscribe, and I will see you next time.